Hello everyone, and welcome to the second episode of World Economics. The first one was quite a success. Thank you so much for watching. And we've received numerous questions to talk about what is happening globally, this slowdown in the global economy, and why is it happening? Why are we not seeing a big increase in inflation with so much money being created after $20 trillion of stimuli from the central banks? What we are seeing is that we hear that there is no inflation. No? Well, the first thing is that obviously there is inflation. There is inflation. Although the CPI calculation, the consumer goods calculation of inflation seems low, the reality is that a core CPI of 1%, 2% per annum, not only is accumulative, but also is showing the beauty of averages. No? There are some products that are rising in price quite significantly in the markets, and others are coming down, and the average is showing a low level of inflation. But there is a reason why the middle class, workers, savers, and people that receive a salary are complaining about the cost of living, is that inflation is actually there. It is not the way, it is not as much as central planners would want, but it is there, and there is a reason why we see the protests in France and so many other countries. So first, yes, there is inflation, and that inflation is accumulative, and we need to pay attention to the disproportionate effect on some parts of the economy, on the salaries, on the workers, on people of middle and lower incomes. Second, of course, there is massive inflation, ginormous inflation in financial assets. When you create credit, as central banks do in the leading economies, what central banks do is not print money per se. What central banks do is print credit. They increase their leverage to buy sovereign bonds. When they buy sovereign bonds, they make the least risky and the most secure asset, allegedly the sovereign bond, extremely expensive. So it creates inflation in sovereign bonds. By making the lowest risk asset very expensive, you also make very expensive the rest of the, let's say, palette of risky assets. And the money creation that does not go to investment and to consumption, not because investors are not using money to or companies for the capex that they require, that they see as necessary, not because consumers are not spending, but because they're not investing or spending what the central planners want them to spend or to invest, which is a completely different thing. It's completely different to say that US companies are not investing as much as central planners would want them to invest, and I don't know where they get the figure, compared to the fact that they are absolutely investing in what they see as opportunities and according to their businesses, their expectations, and the reality of the economy. So the first thing that happens then is that less investment than what central bankers and central planners expect, less consumption than they expect, goes, obviously all that money goes to financial assets, and financial assets have been absolutely rocketing. Private equity multiples, equities, stocks, high yield bonds at 35 low yields, 35-year low yields. All of that has created a massive bubble in financial assets, and that is what we are seeing right now. So, first thing, yes, there is inflation. Second, there is massive inflation in financial assets. So the next question that we receive is, why don't governments literally just create money to finance government spending? Governments will spend more, the economy will rise, there will be more employment. Fantastic, beautiful. No, it doesn't work. It doesn't work because of the same thing. The reality is that what you're doing is that the first recipients of the new money created are the ones that benefit the most, and the ones that get it last are the ones that pay for it. And the first recipients are always governments. So government receives a lot of money. Government receives a lot of money to spend on what? They don't have better or more detailed information about what are the needs and requirements of the economy. In fact, they have all the incentives to malinvest, overspend, and more importantly, to defend the sectors in process of obsolescence. Therefore, what ends up happening is that governments will spend a lot, and actually more than what would be needed in any economy, because they don't suffer the negatives of doing a bad investment. They just get the money, they spend it, and we have seen it over and over again with these massive infrastructure plans of 2009 in the European Union, with this huge government spending plans in France or so other countries that don't work. No. Secondly, you create when you create money directly to finance government, what you end up doing is destroying the purchasing power of the currency. And the reason why governments continue to print money is because they have the perverse incentive to continuously destroy purchasing power relative to the other parts of the economy, savers and investors. It is a complete fallacy that a government with monetary sovereignty can issue all the debt that it needs in local currency without risk of default. First, there is evidence of more than 27 defaults in local currency of governments with monetary sovereignty since the 1960s. So the first part is incorrect. The second thing is that governments issue in foreign currency not because they are irresponsible, not because they don't understand the magic of modern monetary theory, but because there is no real demand for their bonds in local currency. And why is there no real demand for their bonds in local currency? Because their own citizens, savers, investors all over the world don't want to suffer the currency risk, because you know that the government will continuously depreciate the currency in order to try to repay that debt that it cannot pay through normal means. So it is not true that governments can issue all the debt that they want if they have monetary sovereignty, because it is not true even in the United States as the world reserve currency. It also sees its bond yields rise, and you can see that there is a completely different metric. More importantly, if you look at the United States, the reason why its bond yields are so low, it's because it has a massive and only principle constantly in its messages to the market, which is the US does not default and capital inflows are welcome. It is all about defending the inflows of capital into the United States. The way in which other governments create their policy, their monetary policy, is against capital inflows, because through currency devaluation and through massive government spending, they are rejecting capital from outside. They are basically becoming the opposite of what the United States is as a world reserve currency. So the other point is, obviously, you can issue all the money you want because you are the government and you have the monopoly of issuing currency. Therefore, there is absolutely no problem in continuously printing more money in order to finance government spending. That is not true either. There are more than 150 cases of fiat currencies that have disappeared because of high inflation. And the reason why that happens is not because the governments would not want to continue to issue currency, is because the citizens themselves reject it. No? We have seen it in Ecuador, we have seen it in so many countries in which citizens themselves just basically, they don't want the currency. The moment that they earn a salary or that they get some currency from savings or from any place in local currency, they go somewhere else to exchange it for gold, for dollars, for anything else. No, we see it in Argentina constantly. So, no, not true that governments can issue all the debt that they want in local currency without risk of default. There's been more than 20 cases of sovereign defaults in local currency. No, it is not true that a government with monetary sovereignty can issue all the money it wants or that it needs, but because we have seen more than 150 fiat currencies disappear in the process. Furthermore, if you think about it from the perspective of the neo-chartalist view, the reality continuously conflicts with magic. Reality is the following. The idea that money supply and demand of money grow in tandem and that the government has better or more information about the needs of the economy in order to avoid an inflationary spiral is completely farcical. Is completely false. And the reason why it's completely false is because the government has the incentive of overspending, of malinvesting, of putting a lot more of that newly created money into sectors that generate overcapacity and crowd out the private sector. More importantly, it has the incentive of, once all that stops working, to try to repeat it continuously. And that's why it is not true and has never happened that money supply and demand of that money grow in tandem. More importantly, it is absolutely incorrect that you can think that the first recipient of the money is not going to have a perverse incentive to continuously get that advantage. Of course it will. Of course it will. And it will be, and it always is, at the expense of savers and salaries. And more importantly, when you look at the entire spectrum of money creation, whether you create credit like central banks do right now and generate massive inflation in financial assets and inflation in goods and services, or whether you create money to finance government spending, in reality, what you're doing is literally a transfer of wealth from the productive sectors to the inefficient sectors, to the unproductive sectors, all the time. It is a constant tax. It is a constant increase in that transfer of wealth out, that sucks wealth out of the productive, out of the savers, into the unproductive and the inefficient. And that let's say that the virtuous circle of credit creation, which is that the short-term credit cycle and the long-term credit cycle rewards the efficient and penalizes the inefficient, is reversed. You basically consistently penalizing the efficient via crowding out and via getting less of the newly created money by basically taxing the efficient out of the system via inflation and devaluation. But more importantly is that as you see the long-term cycle, in the long-term cycle, what ends up happening as well is that you have a perverse incentive to continuously reward the inefficient, because it is those inefficient sectors are going to be the ones that demand more and more credit to continue to stay alive, a running to standstill strategy, and penalize the efficient. If the system right now, with the chain of monetary policy, is already showing very dangerous penalization of the efficient and, more importantly, benefit of the inefficient, with the rise of zombie companies, with the massive increase in government deficits and increase in government malinvestment and all those things. If that is already happening, imagine if you turn around that chain of monetary policy trickle into the economy, and you basically break it by giving all the power of both money creation and expenditure of that money into one single entity that does not suffer at all from doing things incorrectly. In reality, the transfer of wealth can only be acceptable, as we have seen in the last 50 years, if there is a quid pro quo by which the last recipients of money get more in the long term than the first recipients of money. That's how monetary policy has worked in the last 50 years. We have broken that since 2009, and it's just getting more and more complicated because, as we are seeing right now, the perverse incentive of the first recipients is to extend and pretend. But it creates populism, it creates uncertainty, and it creates definitely unrest in the rest of the population that suffer the effects of that malinvestment and that lack of monetary reality. So the reality at the end of the day is that there are no magic solutions, and that the only way in which you achieve better growth and better salaries is with higher productivity, rewarding the efficient, not rewarding the inefficient. Thank you very much. See you soon.